Good afternoon and welcome to the HRQ Quarterly Economic Insights Series. I'm Sal Vergara, Vice President, Client Solutions at HRQ and Landrum HR. These quarterly economic webinars were developed to help companies not only make sense of the often conflicting data in today's market, but also gain valuable perspective that can help organizations build resilience and take advantage of emerging opportunities. A recording of this webinar will be sent to everyone who registered. Please feel free to ask questions using the questions pane in the control panel. There'll be a quick survey that pops up as you exit the webinar today, and we'd certainly appreciate your feedback. It's my pleasure to introduce to you Brian Wilkerson. Brian is the head of HRQ's consulting service lines and is a frequent nationally invited speaker and is regularly sought by the press for his thoughtful insight. Brian is known as an innovative strategist and has applied his cutting-edge planning techniques around the globe, where he has become known for helping companies gain an edge through counterintuitive strategies. He's authored a number of articles and book chapters in his areas of expertise and has held senior leadership roles in both large enterprises and global consulting firms, and is a successful entrepreneur who has founded and sold multiple companies. Without further delay, Brian, I'll turn it over to you, sir.
Thanks, Sal. I appreciate it, and welcome everyone to our quarterly series. I'm going to do things a little bit differently today. I normally save a lot of the strategy and what you should do about it discussion until the end, but there are a number of things that we're starting to see in terms of potential slowdowns and things of that nature that really demand sort of more close attention and more close action. More importantly, we're seeing a lot of organizations already start to react to almost impending economic news and where they're projecting things are going. So I think it's really important to talk about some of these strategies and reactions that organizations are having. So I'll be talking about those as we go through in a number of cases and look at the data. I wanted to start by looking at the labor force overall and what we're seeing in terms of some trends here. When we look at labor force participation, it basically looks at, how many people or the percentage of the eligible folks are actually participating from a workforce perspective. We're seeing that the numbers in terms of labor force participation are continuing to rise, and it's going up every month. However, behind the numbers, you're seeing some interesting trends and some other things that we need to talk about. So when we look at labor force participation rates, it's basically the number of people in the labor force over those that are eligible to be in the labor force. So while the numbers themselves in terms of people participating in the labor force are increasing, and the raw numbers in terms of number of people participating are reaching pre-pandemic levels, we're not seeing the labor force participation rates actually getting back to that level. The reason for that is that we actually are seeing population growth, more people eligible for the workforce, but we're not seeing the participation rates coming back. A lot of speculation in terms of why that is and what the real reason behind that is. It ranges from, childcare issues and issues in terms of being able to access the workforce, increased numbers of people that are on disability and therefore not able to work, all the way over to worker preferences and people having different perceptions of where they want to be from a workforce perspective, what kind of jobs they want to take, being more willing to stay out of the workforce if they don't find something that matches that, and frankly just mismatches of available jobs and skills to the workforce that's out there. So if we were actually at pre-pandemic labor force participation rates, the numbers would be in the 167 million range in terms of people who are actually participating in the workforce. And as you can see by the chart, we're a little bit below that from some of those numbers. When you look at it in terms of trends, we always look at things from a gender perspective. For example, when we look at participation by gender, men have surpassed the pre-pandemic levels in terms of labor force participation, and women still have not yet. And so it's a trend that we continue to look at, and a number of organizations continue to look at in terms of what are some of those barriers. And I mentioned some of the potential barriers that are out there. It's not really a one source or one answer kind of situation where there's one solution to bringing that participation rate back up, but it is something that needs to continue to be watched and look at what sort of systematic barriers or barriers that organizations can help overcome are out there in order to help increase that labor force participation rate, because obviously that contributes to the the overall number of openings that we have and some of those things that I'll talk about in a bit. From a standpoint of looking at jobs, we continue to get steady growth in job rates. When you look at it, we've basically had consistent job growth since about May of 2020. We've got 500,000 more jobs than February of 2020. We are starting to see those job gains, however, slow over the past 2 months. So the rate at which the job growth is happening is starting to slow down. We saw basically, for example, 80,000 fewer jobs created in the third quarter than there were in the second quarter. So still overall growth, and that's good, but that growth is slowing down. The other piece that we look at is what's called the diffusion index. And basically what that measures is how widespread is the growth in jobs? How much are we getting this across industries, across sectors? And so the diffusion index has actually gone down as we look at that, which means that there are basically less sectors that are having employment growth. So across the 254 industry sectors or so that they look at, then the breadth of employment growth has shrunk. So when we look at both of those factors, overall slowdowns in the number of jobs that are being created, as well as the sort of less dispersion or less breadth from industry sectors that are creating jobs, both of those are kind of concerning signs and things that we want to keep an eye on, because it starts to indicate more of a slowdown in that overall labor market and where that might go. When you look at job gains from a different sector perspective, all of these numbers are seasonally adjusted. If you look at the job growth in Q2, it basically was at 1.6 million, and it's gone down to 1.1 million in Q3, and that ties into what I mentioned before, that dispersion index, and we're seeing growth slowing down in a lot of different sectors. Many of these sectors are consistently the ones that have been creating jobs over the past several quarters as we look at it. And so the certain sectors continue to have growth in some of those areas. And local government has been the driver from a government side, construction and manufacturing on the good side, and a lot of these in the services sector, which continues to be the biggest driver of growth, are similar to what we've seen in past webinars and past quarters in terms of that. When you look at job openings per number of unemployed, this is an important measure because it gives you kind of an overall feel of where we are in terms of matching supply and demand in the marketplace. Last quarter, basically, the data showed that there were 2 available jobs for every unemployed person. And that's when you look at the U3, or the most commonly reported unemployment rate. Similar, it's reduced slightly, so it's just under 2 as it stands now, but we're still really at historic highs when it comes to the number of available jobs versus the number of available workers. And there's still a really strong gap in terms of that. So I'll pause here to talk about that from a bit of a strategy perspective. As we've been working with organizations, over the past several months, we're a lot of these organizations are seeing signs of the labor market softening. But frankly, a lot of organizations are what I would call overcorrecting or overestimating the changes that we're seeing in the labor market and where their bargaining power might be, what the impacts on talent acquisition are going to be, et cetera. I've seen a number of organization leaders sort of enthusiastically look at, well, it's going to be a lot easier to get people. We're not going to have to pay as much and those kinds of things. And that's not where we are. We're definitely not at that point yet. When you look at some of the numbers like these unemployed per job openings, we're still pretty far from that. Some organizations really are seeing this as a chance to kind of correct what they perceive as out of control salary growth. And I want to really raise a caution to organizations to be careful about blanket strategies and reactions to what you might see in the softening labor market. I think that as we look at that market, it's very uneven and it's very tied to industry and geography. So there's a number of industries and sectors and geographies that will continue to see scarcity. And so my caution to organizations is really choose your strategies wisely. I think in addition, while we see some salary premiums likely to go down overall, we're not seeing worker scarcity abating significantly in the short term or even in the intermediate term. I think there will likely be improvements in the availability of unskilled and semi-skilled labor in certain markets and industries, but absent a much more severe and prolonged recession than most people are predicting, there's not going to be widespread worker surplus anytime soon. So it's important to really look at any segment of the workforce that you're trying to recruit or that you're going to need to acquire over the next year. What is your strategy really going to be? And that has to start with how critical are those workers to your goals and to achieving your strategy. Obviously, all organizations have to react to the economy and how it changes demand from their perspective. But I want to be very cautious, or advise organizations to be very cautious about putting in strategies that are sort of like, oh, it's all over and we can kind of go back to the old ways, because I don't think we're going to see that widespread worker scarcity or worker surplus, I should say, anytime soon. So be very careful in terms of how you look at these pieces. When you look at the reasons for leaving, which is another important metric for us to kind of understand where are we and what are we seeing in terms of company reactions and those kinds of things, reinforcing the point that we're not seeing a major softening, the number of people leaving their jobs has been relatively steady at about 6 million per month. We have seen a slight uptick in layoffs as the reason for people leaving the job, and a slight decrease in quits over the past several months, but we're not seeing layoff levels anywhere near what we would typically see in economic downturn, recession, those kinds of things. You can see, if you just look at the chart and kind of look at it from an instinctive perspective, the green part, which is layoffs and discharges, still hasn't become a major part of the line. Quits and people voluntarily leaving their job is still the major reason why people are departing, a major reason for job leaving. We're obviously not seeing anything close in terms of the numbers that we saw during the pandemic or even what we've seen in other recessions. So again, just a caution in terms of, as people are looking at data that's out there, that we're not seeing a huge softening of the labor market. When you look at unemployment duration, again, another key metric when you're starting to look at where are we from a labor market perspective, unemployment durations actually continue to decrease. And I think 2/3 of the people who are unemployed are at 14 weeks or less. Long-term unemployed numbers are down 19%. Again, if we were seeing major softening, these numbers would be increasing. We'd be seeing a different trend. And it really reinforces what I noted previously about exercising caution in your labor strategy adjustments and not overcorrecting. I wanted at this point to actually take a minute to address kind of an interesting piece of reporting that was recently out. And it said basically that there were a number of CEOs in this survey that intended to get rid of remote workers first if there was a need for layoffs. Many of you may have seen that piece of news. It got a little bit of traction that was out there. It's got a lot of interesting reaction, but frankly, I'm not really all that surprised. I think we've been talking about for quite some time now about the friction between leadership views and worker views on topics such as remote work, hybrid work, where we are from a state of productivity perspective, and a number of other kind of future of work issues. I would characterize the current state of things as an uneasy truce. Many leaders have gone much further down the remote/hybrid work path than they're actually comfortable with. And because they've done that because of the dynamics of the talent market, but many feel, and I hear this all the time, that what they're doing now is hurting productivity, collaboration, and innovation. And many leaders in the organization believe that this is not panning out the way that it was promised in terms of the benefits that this would deliver to companies. So I would argue that many companies have not really made the systematic investments in management capability that would be needed to truly manage a different future of work, a different work environment. In a lot of ways, we're just, incrementally shifting how we do things, but applying a lot of the same old management techniques to a very different work environment. I think the next several months are really going to reveal a great deal about the velocity of some of these trends, how much staying power some of these things have, and where we're really going in terms of, overall future of work environment, hybrid work, some of those pieces. So, I think to summarize a little bit, when we look at some of the labor data that's out there, we are starting to see a slowdown in certain areas, but we're not seeing a major downturn. We're not seeing a huge changes in demand and things like that. What we are starting to see is organizations maybe overreacting or overcorrecting in some cases, and perhaps going down some of the wrong paths from a strategy perspective. So it's really important to step back and start to look at those things now and pre-plan, get ahead of some of these different trends, and think about what your organization's reactions might be. I'll talk more about that in terms of potential organization reactions and some strategies that the people can start to get behind. I think we talked the last webinar that the Census Bureau changed the small business survey that they were doing during COVID to this business trends and outlook survey. It's interesting in looking at this data. It's a bit of a mixed bag. Most organizations are really seeing neutral trends in some of the key metrics, such as hours worked, the counts of paid employees and where those are going. But we are seeing some concerns from numbers such as 34% showing declining revenues and still high delivery times from suppliers. There are about 23% of businesses projecting an increase in demands for goods and services. So there is some enthusiasm out there as people look forward, but overall, these numbers are very very cautious, I would say. You can kind of look at the gray lines, which is how many people think that or where is there no change in sentiment or in actual results, and those numbers are the majority of those lines. Those places where you see the green are tending to be small. So I think there's a great deal of caution out there from an organizational leadership perspective in thinking about and what they're seeing in terms of where things might be going, et cetera. From a self-employed perspective, I've talked about this a number of times. There's been a structural shift since COVID, and the numbers in terms of numbers of self-employed have stayed within a fairly predictable range for quite some time now. So we're kind of in this same trend. We usually see when there's an uptick in or a downturn, and there's usually an uptick in self-employed, and a lot of times that isn't by choice. So these numbers kind of holding steady as we look at these pieces. One of our biggest concerns really still comes down to inflation and its potential impacts. When you look at a gap of 8.2% increases in consumer prices versus a 4.7 increase in hourly earnings, this gap has started to close a little bit with recent data, but it's still high. Negative real wage growth is considered recessionary, and it reduces consumer spending power. As we always talk about, a great deal of the US economy is driven by consumer spending. So this continues to be an area of big concern for us. But even more concerning, consumer confidence fell for the second straight month. And there's a different number called the expectations index, which essentially asks people about their short-term outlook for income, the business market, labor market, and those kinds of things. That number in terms of people's optimisms or expectations has actually gone to its lowest point since 2013. So, almost a decade low when you look at people's outlook about what's going to happen in the future. So consumer confidence declining, still, at a decent number now, but people's outlook has really reduced. And I think when we look at that, it's highly concerning. And if you look at that coupled with numbers such as people's major purchase intent or intent to purchase major items having gone down, and cooling significantly since Q1, consumer sentiment and where people are and what they're feeling about the economy is certainly a concern for us. I think we're going to see, some of this play out in the election, and a lot of the data that I've been seeing in terms of what are people concerned about, what are they voting on, economic issues certainly are high in terms of that, inflation and a number of others being, significant concern for people out there. So I think this is going to continue to be front and center. It's going to continue to be an issue that we keep track of, and really want to make sure that we're looking at where is the workforce, where are people in terms of their sentiment, and both as a predictor of where the economy overall might go, but also in terms of worker sentiment and how organizations might attract and retain workers. When you start to look at some of the trends that we look at for leading indicators. So these are really long-term trends about the numbers that I've just talked about. And really none of these graphs are going the way we would like to see them. None of these trends are heading in the right direction in terms of that. From a strategy perspective, we're at a point now where it's critical for organizations to really think about their employment brand, engagement, and really important communication strategies. Employees, and what a lot of these numbers tell us is that employees have a great deal of concern about the economy, their personal situations, and they're really trying to discern what's their company's outlook, what kinds of strategies is their organization thinking about, et cetera. Now is really the time to be proactive with messaging and build honesty into communications. What we've seen in past recessions over and over again is how organizations handle things and how they communicate can have a really significant impact on their overall employment brand, as well as talent retention during and post downturn. The implications are much longer term than whatever the duration of the economic downturn are. So what organizations do now can really set them up for success or failure going into any sort of economic downturn, as well as over the longer term, and really can, the wrong moves can create much longer term damage to the employment brand. So thinking about communication strategies, getting in front of these things. Hey, we know people are concerned about a downturn. This is what we're seeing in our industry. This is what we're seeing in our sector, positive or negative, right? And trying to give folks a sense that leadership is on top of it. Leadership is paying attention. We're, thinking about strategies. We're thinking about ways to do things, and, communicating out your guiding principles and how you might look at, any actions that you may need to take, et cetera. Not, overcommitting yourself or promising things that you can't deliver, but really starting to give people a sense or confidence in leadership, that leadership's on it and leadership's handling it, and they're looking at these things the right way. So again, would encourage organizations to really think about proactive strategies and ways that they can come in and try to, look at and address some of these concerns. The good news in some of this is that we're starting to see, or we've seen inflation start to moderate somewhat. Prices in many categories are continuing to increase, but at a slower rate than we've really seen more in more recent history. So that is a small amount of good news anyway. When you look at that, energy and commodity prices have reduced overall, but it's unclear how some of those sort of intermediate trends are going to be, given that there have been some interventions in the market in terms of trying to reduce short-term prices, and how long-term that staying power is going to be, et cetera. So we'll see on that if we continue to see those prices reduce and how long that trend keeps up. But inflation moderating certainly is good news as we look at it, especially when you start to look at some of the interventions that have been out there in terms of interest rates, et cetera, and where some of that might go. Seen concern from a lot of economists, certainly about, acting too aggressively on inflation and pushing us further into, recession or some kind of downturn, and a lot of concerns about those pieces. And so it's good to see some of this moderating, and hopefully we can see some of the responses and some of the strategies start to moderate as well. When you look at GDP, so again, as we often do with these, new numbers got released today. So as a reminder, we saw essentially 2 quarters of decline in Q1 and Q2. The good news is that the projections for Q3 are a 2.6% increase in GDP over Q2, so reversing to downward quarters. So that's certainly good news as we look at it. Increases were in the areas of exports and in consumer spending, so that's good. Counterbalanced by decreases in housing investment. And of course, that's something we've been watching very closely. Housing changes and changes in the housing market have been, a precursor to the last couple of recessions. And so it's really important data to continue to look at. I want to note that the increase driven by consumer spending is obviously a bit concerning to us, given some of the numbers that I just talked about in terms of consumer confidence, intent to purchase. Really looking at some of the sentiment about where things are going, because that's continued to be the engine, and that's what helped growth in Q3. But if we start to see people pull back on that, then we're obviously at risk for a continued decline. So, likely some of these numbers and some of these things will revise slightly in terms of the final analysis, but the projections are good news for now in terms of where we're heading from a GDP perspective. If you look at GDP growth by the different industries and some of the pieces that we've got here, Q1 versus Q2, this is still that Q1 versus Q2 comparison. We don't have Q3 yet. The non-durable goods manufacturing was the only sector where we saw consecutive quarters of decline. When you look at the pieces between these two, we'll watch closely what sectors were increased and decreased in Q3. But the good news is that we aren't seeing one industry necessarily go and crater from a GDP growth perspective, where there has been some pain. It's been counterbalanced in some of those things. Some of the places, like if you look at mining, it declined and then it went to neutral. When you look at some of the things like accommodation and food services, it went from basically decline to growth. So we're not seeing these prolonged trends in most industry sectors where GDP is growing down. So that's good, and we'll see what happens in Q3 and what some of these trends look like. If we can see weakness in particular segments, in particular industries, again, that's going to be an important indicator for organizations in terms of thinking about their own strategies, their own plans, and what they plan to do. From a leading indicators perspective, we're starting to see some tapering in some leading indicators, such as commercial construction and residential housing sales, but we're not seeing steep declines as of yet. I mentioned housing is one we certainly watch very closely. I think the interest rate situation is going to continue to have a strong influence here. And so how the markets and the Fed, digest some of the data that I've been talking about and how they change or adjust some of their strategies is going to be really important. If we start to see steeper declines in a couple of these areas, then we're going to be, we're going to be even more concerned in terms of where the economy is going. When you look at durable goods orders and new business applications, those have, really been fairly steady as we look at it. So that's good news. The annual growth rate for durable goods orders has slowed and is less than 9% now. So something to watch. As we look at the new business applications, fairly steady in terms of some of those pieces. About 40% of those are in retail, professional services, and construction. So if you think about the areas that I talked about earlier where we've seen job growth and GDP growth, some of those things line up in terms of those pieces. So nothing too surprising in terms of that. So just a few other signs of concerns and things to watch out for as we look at where we are. So one, worldwide inflation and supply chain instability continue to be an issue. Energy obviously is front and center for a lot of folks in terms of that, not only just given global supply, but also what's going on in Ukraine. the flow down effects into Europe and concerns about rationing and price increases and things of that nature. So still a big driver of uncertainty and potential instability. We are seeing, and I've mentioned this and you saw it in some of the numbers, slowing manufacturing as the demand for certain goods decreases. Complicated or compounded, I should say, by people's intent to purchase and overall enthusiasm about the economy reducing as well. Stock market, probably no one needs a reminder of where the stock market has been and what we've seen there, but there's a lot of nervousness, a lot of concern about where things are going, how different regulatory bodies are reacting, et cetera. Higher interest rates, definitely slowing the housing market for both new and existing homes. And as I've mentioned before, that's usually a precursor or indicator of, pending economic problems. I think that we're seeing, labor market data cooling overall, not significantly, but we are starting to see some signs slowing down. And so we continue to have some concern about where all that's heading. So to really talk about, what should you be thinking about now and where should you be focusing your time and energy? Many organizations are starting to move into their, 2023 planning, whether that's a full, strategic planning process or whether it's a budgeting process and an annual planning process where you're setting goals and dollars and things like that. It's going to be critical for this planning cycle to be looking at, economic contingency planning and thinking more for 2023 about scenarios rather than one plan. Depending on who you want to believe and listen to, we're driving off the economic cliff any day now to, oh, everything's going to be fine. And if we do go into recession, it's going to be brief and not bad. You can you can take advice from whoever you want on that, but I think when you look at it, what it does imply for organizations is the need to really think in terms of scenarios and contingency planning, and what might some of our responses be. So as an example, if you take a very simple approach and say, what's the worst case, what's the best case, what's the likely case, when you're starting to do your revenue projections, your growth plans, your expense projections for next year, very important for organizations to get ahead of those scenarios and think about what does our reaction need to be and when would we need to know that we need to react. What we're really advising organizations to try to avoid is, those more severe knee-jerk kind of reactions. We waited too long, now we have to lay off, 25% of our workforce, rather than being able to look at controlling hiring, controlling, some of the expenses and some of those things based on, a more close watch on numbers and economic indicators and things of that nature. So rather than put yourself in reactionary mode, try to create some different scenarios that will really tell you, well, if we start to see this, these are the reactions that we're going to take. This is how we're going to pull back on the gas or how we're going to address some of these issues, rather than having to go to some of these more severe actions that can have the impact on employment brand that I talked about, on the ability to really retain workers over the long term, et cetera. So a more scenario-based approach to your annual planning or your strategic planning is going to be a really critical element for surviving and thriving through the upcoming year. Secondly, labor strategy is really an important piece, and looking at that people supply chain. We've talked about this a lot, but I continue to see this as really a critical element for organizations to, again, put themselves in a position of advantage. So looking at the labor strategy, looking at your sources of labor, and thinking about it from a couple of different metrics. Cost tends to be one of the drivers that people use when looking at that labor supply chain, but I would argue that we really need to start to look at things like reliability, predictability, other kinds of metrics that we would typically look at when we are looking at the supply chain, but start applying that to people as well. Similar in terms of the contingency planning and scenario planning, the key is to be able to get ahead. The key is to be able to see changing trends, respond to them in a timely manner rather than getting caught flat-footed. And frankly, getting caught flat-footed either way. you may be in a fortunate position of your industry continuing to grow and continuing to see increases during any kind of downturn, and you have a need for really ramping up and continuing to get people during that time. I wouldn't just count on the fact that, oh, there will be more people, out there and available, and we can get them when we need them, because that won't universally be true. So having that labor strategy and thinking about even flexibility in the supply chain. So as you look at your planning for 2023, how do you create flexibility in your workforce so that if you see an economic downturn, you can respond appropriately in a very nimble, very agile kind of way, rather than having to go through mass layoffs or things of that nature. You can kind of govern, hiring, contingent labor force, things of that nature, in order to be able to respond appropriately to what you're seeing from an economic perspective. So having that labor strategy nailed down and people's supply chain is really critical. It's it's very analytical. It's something that you really need to be able to have the numbers, try to look at tying, economic indicators and company metric indicators to your labor force and your labor strategies. A lot of organizations struggle with this. They don't have the internal analytics horsepower. They don't have the internal, kind of insider expertise on really how to look at some of these things. So these are places where a lot of organizations will need outside help in order to really do this effectively. Another piece to look at on the upside of things is what sort of strategic business and labor opportunities does the coming environment create? If your organization is in a position of strength financially, or wherever your position in the marketplace, start looking now at the scenarios and say, well, if we start to have some weakness overall, where might some of our competitors end up? Does it create an opportunity for us to acquire them as a company? Does it create an opportunity for us to take key talent from them and really build our own capabilities by stealing that strategic talent? Looking at strategic labor opportunities, including where there are places where we can do more automation, where we can do more outsourcing, more contingent labor, creating that flexibility that I was talking about, that responsiveness, that reliability. When you look at some of these things, if you are in a fortunate position of being able to weather, or in being in a position of strength as the economy turns, now's really the time to be thinking about that. And the more you can get ahead of those things, the better. What we saw that was different in the last recession was there were a lot of companies who very early on took advantage of weakness in the market to strengthen themselves and better position themselves. Much faster reaction than in previous recessions. In previous recessions, it's sort of everybody weathered it together for a while, and then there were some companies sort of stuck their head up and say, hey, we're in pretty good shape. Let's go out there and try to do some strategic things, from a company or a labor perspective. Last round of recession, that happened much faster. Organizations that were in positions of strength got out there fast and really took advantage very quickly. So be thinking in your planning, and as you start to look at different contingencies and scenarios for 2023, where might some of those opportunities be, and how might you go out and capitalize on some of those pieces? So I think that's a great opportunity for organizations, and it's a natural time to be thinking about that and talking about that, given where we are in the year and in the planning cycle. Good supply chain optimization is going to continue to be an area that organizations need to focus on. And I know I've brought this up a couple of times before, but when we look at where the global supply chains are, we still see significant threats and significant issues in a number of different places. There are, if you look at things like chip supply and things of that nature, yes, we're starting to see some policy responses and some programmatic responses to some of these things, but those responses are not going to create short-term relief. And so we are going to continue to see a number of challenges from a supply chain perspective. This ties into the strategies that I raised above. So when you look at your contingency planning and your different scenarios for 2023, it's critical to look at them from not only a standpoint of, well, what might happen from an economy perspective, but what might happen from a supply perspective, and how might that impact us? if we continue to see shortages in certain areas or they increase in certain areas, how is that going to affect us? Then how is that going to flow back into our labor strategy? And, again, being able to take advantage of some of those flexible labor options and how those implications are. So a lot of these first four in a lot of ways really tie together in terms of thinking through the whole picture of your economics, your growth, your potential issues from an industry perspective, and where you're positioned in that industry. So thinking about this from an integrated planning, tying more of your goods supply chain and your people supply chain together, being able to look at different scenarios, understanding when and how to react, looking for opportunities and weaknesses in the market that you can potentially capitalize on. All of these really tie into a good planning process. So if your organization is just sort of looking at, what's our budget going to be next year, and not thinking through some of these more strategic pieces and their implications, probably putting yourself at risk, as well as missing potential opportunities that you may be able to take advantage of and that you may be able to to hit in the marketplace. Finally, really taking a look at 2023 and looking at your compensation and retention strategies. And I want to spend a minute on this because it's really important, and it's one that I think that people are not doing well so far. So a lot of organizations over the past year and a half have taken a very critical look at their compensation approaches. Where do they want to be in the market? How do they want to pay? And most frankly have looked at it and said, we're behind, at least in certain areas. We're behind, and we're not keeping up with certain positions, certain labor types, things of that nature. And so a lot of organizations have made adjustments. Where they are in the range, additional benchmarking in terms of making sure their salaries are competitive. In some cases, adding back in cost of living increases and things like that to try to respond to inflation, and some of those things. A lot of organizations are now taking a look at 2023 and saying, okay, well, how much do we need to do? How aggressive should we be? What should our philosophies be, et cetera? I would throw out a couple of things as you're considering that piece. One is that, inflation and those sorts of economic issues are still very much top of mind for a lot of people. And a lot of folks, we're seeing, things like personal savings rates go down, and, a number of issues that would indicate there's a lot of concern, a lot of economic distress out there that hasn't necessarily fully manifested itself in the market, but the leading indicators are there. So it's going to be really important to be thinking about what are your compensation strategies. Simple example from my recent observations. We have a number of clients in the public sector who have gone in and really sort of looked at their economics and said, we haven't kept up. We're going to do a one-time or an ongoing sort of cost of living increase. And then another, public sector entity that happens to live in a place that's very expensive, very high cost of living, basically said, no, we're not going to do anything along those lines, even though, a lot of their workers are probably suffering more in terms of, inflation and some of the changes in the marketplace. The reaction to that, even just that announcement that they weren't going to do cost of living, has been swift and severe, right? In terms of what they've heard from employees, people quitting, things of that nature. And so the workforce is on edge in many ways. And so you're really going to have to think through your compensation strategies and make sure that you're not overly enthusiastic about what a downturn might mean for you. And that ties directly into retention strategies and making sure that you're really thinking about the critical segments of your talent. Who do you need to retain, and what is it going to take to do that? This is one of those places where you really have to have a more nuanced strategy in terms of how you deal with different segments of the workforce. So let's say that you're in an industry or in a market where you feel like there's going to be an overall decline in terms of demand and things of that nature. It's important to think about your critical talent segments and the ones that you want to keep no matter what. and what's it going to take to do that? Whether it's because they're just critical to you operating, whether it's because you want to make sure you have them as things start to turn, there could be any number of reasons. But it seems strange to be thinking about, retention strategies when you're facing a potential economic downturn, but it's going to be critical. When you look at the state of the labor market and those kinds of things, there are going to be people who, kind of do what I mentioned earlier and take advantage of weaknesses and look for opportunities to strategically steal talent, et cetera. So you really have to think about your workforce in different segments. Which ones do you need to protect? Which ones do you need to retain? And how do you make sure that you have a strategy to do that for those folks? Do not fall into this sort of blanket strategy or knee-jerk category where you haven't thought through all these different segments and you're just saying, the overall labor market's going to get weaker, we're not going to worry about it, and get caught later. That critical talent is going to stay critical. So it's really important to think about what your strategies are for keeping those. And then how do you really tie into that overall compensation strategy for next year? How do you not overcorrect or misjudge where the market's heading? So thinking those things through, coming up with the right strategies for your organization is going to be very critical. As always, I left it with lots of things to do. Sorry about that. But this really is a very important time and a pivotal time for organizations. A lot of organizations, as they start to look forward, they're going to come to kind of an inflection point in their organization, and the decisions they make are going to be critical to their long-term success or short-term issues, frankly. So reaching that inflection point and making the right choices is really critical. And I think we're going to see a lot of organizations come to that point this year as we get into 2023. Certainly, we're there and happy to help organizations as you look at some of these things and think through those pieces. With that, I will open it up for questions.
Thanks, Brian. There's a lot of great information as usual in these summaries. I've got a question. As we wrap up 2022, are there any unexpected developments from an economic standpoint that surprised you?
I think that the impact that rising interest rates have had, and how fast that has created, put the brakes on a number of economic indicators, has been a surprise. But the biggest surprise to me is kind of the overreaction that people are having to some of the weakness that we're seeing, and sort of thinking that, like, hey, all my problems are over and I'm going to be able to get people just like I did in the old days. And I really worry about that, because we're not seeing any data that says that that's going to happen. So that's probably been the biggest surprise for me, is how much people are almost counting on a recession to try to address some of the issues they see from a cost perspective and from a compensation perspective, because I just can't see it playing out that way.
Great. Thank you for that. Question came in. Do you think we'll experience the same kinds of supply chain chaos we saw during the height of COVID?
The short answer is no, not quite to that degree. But I think that a number of places there are systematic problems that aren't going to fix themselves, anytime in the short term. I mentioned chips earlier, and I think that's a big one when you look at it, because there's a structural shift that's been taking place in there. Long-term investments have to be made to fix some of these things, et cetera. So, a lot of that stuff is going to be an issue. Even when you look at some of the trends that are out there around moving away from, gasoline-powered vehicles and putting more emphasis on electric powered vehicles and those kinds of things, I think in a lot of cases we've underestimated what some of the supply chain impacts of some of those shifts are going to be. And we're going to be sitting there saying, oh, well, what happened to this? We need this component, we can't do it. So I do think that we are going to continue to see some shocks from a supply chain perspective, but not nearly as widespread, and probably not as deep in some cases as we did during COVID.
Great. Thank you for that. Thank you for that question from the audience. One of your slides, you had new business applications seem to steady off during the balance of this year. So with expected economic volatility in the first quarter of next year, where do you see this moving?
I think that we'll continue to see a fairly level effect for at least Q1. You know, it's interesting. You think about, New Year's resolutions and all those other kinds of things, and a lot of the dynamics that happen every year when people get paid out their bonuses, and they may have been thinking about, doing something different, and that's kind of the time that they do it. So I wouldn't be surprised if we see, a fairly level trend or maybe some slight uptick as in Q1. But I think past that, it's going to be very dependent on the economy. I think the thing that worries me is that there's still a lot of segments, retail and accommodation and food services and some of those kinds of things where the worker shortages are so acute. Probably everybody on this call has, gone to a restaurant that was supposed to be open, but they had to change their hours or, reduce their service or things like that because of worker shortages. And so I continue to see that in just levels that we haven't seen in the past. And so I worry that that's going to hinder, people who might have otherwise tried their hand at, a new business or some of those kinds of things. What we've seen is a lot of job growth in those spaces and a lot of economic activity in those spaces. But my concern is that, worker shortages can continue or may continue to curtail that, and we won't see as much of an increase. But I think in Q1, you'll probably see, the numbers stay fairly steady for maybe reasons that you wouldn't expect. But we'll see
Sure.
what happens after that.
Well, that's a little bit reassuring there. And we've seen this here, this next question, we've seen this here within HRQ. That's what we do. But, there's back to work concerns, remote versus on-site. That question was pervasive when organizations were figuring out their labor strategy for the past couple of years now. Now that most of the companies have figured out what stance they'll take, or they should have figured out, right? It's the operative word.
Right.
Is there a challenge on the horizon, do you think? Will this come back, remote versus on-site, or do you think that's kind of leveled out?
Nah, it's coming back. I think that what we're going to see is that this is going to come to a head again, and it's going to, that friction that I talked about earlier in terms of how leaders perceive some of those issues versus how workers perceive some of those issues, it's going to boil over. I think what's going to happen is that you're going to see a number of organizations pull back on some of the things that they've done, or maybe moderate is a better word in terms of some of the things that they've done. I think all the things that we're seeing with very permissive, remote work policies and those kinds of things, I think some of those gains will go away in terms of that. But I think it's going to cause also some continued chaos in some of the patterns that we see. So I mentioned earlier, we're having problems with labor force participation. We're having issues with, far more job openings than there are, people to fill them. You can't ignore sort of the change in expectations and what people think work should be and a work environment should be as, part of those issues. So what happens when there are less jobs, there are less opportunities, people have been hanging out of the workforce for a longer period of time, and that's the moment that companies choose to dial back on, maybe some of the policies that they've had around that, et cetera. It's going to be interesting to see what happens. Some people may have to take positions that have work environments that aren't their optimal, just given economic concerns, et cetera. And so I do think we're coming back for a round two, and it's probably not until after we get through that we really know what some of the long-term trends and long-term velocities are going to be around some of these pieces.
Sure. And that's an interesting perspective, an answer, because I was talking to a few companies here this week, and they seem to have, in their mind, figured it out and are
Mm-hmm.
pretty set on the stance that they're going to take. And both of these, coincidentally, are ones of bringing folks back. And
Mm-hmm.
so
Yep.
my question back, and this was a CFO I was speaking with, was, do you anticipate there pushback from the candidacies out there, the folks that are looking for jobs? And these folks don't seem to think so, but I beg to differ a little bit that, he at least acknowledged that this is a candidate's market. They have a little bit of
Yeah.
leverage as to where they can go. So it will be interesting in the next few months as this trend might rear its ugly head again. I shouldn't say ugly. I mean, it's reality. And for lots of folks, this is a great setup to be working remote and hybrid, et cetera.
Yeah. Well, I think there are people in the workforce who are looking for a little bit more of a middle ground solution. You know, there are folks who, while they enjoy the remote work, they enjoy the flexibility, they do like having some kind of anchor, you know,
Sure.
and at least some interaction with people. And so, you know, my guess is like a lot of things will get more towards a middle ground over time. But I do think that it's going to be a differentiator for companies. And, you know, depending on what your preferences are, you may go one place or another based on how they have these things structured.
Right. Right. Well, we're coming up to the top of the hour. One last question here. As you and I have had conversations with companies and organizations over the past few months, do you feel, based on what you've seen and heard from these individuals, are they prepared? Are folks ready for this, or are they being, you know, kind of utopic in the way they think that things are going to level out and get back to quote unquote normal?
It's definitely a have and have not situation. You know, I'm seeing a number of organizations who are being very thoughtful, very strategic, very proactive in terms of trying to plan around this and think about what they're going to do. And then, you know, there's a whole segment that is just still very reactionary, very like, well, let's see what happens and we'll kind of figure it out as we go, which, you know, I worry about, of course. But I am seeing a fairly good segment really starting to at least have these conversations, even if they haven't nailed down all their strategies, they know they need to, and they're trying to work through it. You know, I've been working with a number of different companies who are trying to really get a handle on what could happen and what some of their reactions would be. And it's very encouraging to see. And I think actually those leaders feel much better and feel much more confident because at least they have an idea of where could it go and you know, how might they react.
Right. Right. Well, let's hope everyone does take heed and is prepared with some semblance of a plan as we wrap up this year and head into 2023. So, Brian, again, thank you for the time and effort that you and the consulting team put into providing this content today. Audience members, if you have any questions or if you need any support for your HR initiatives and projects, please reach out to us. We'd be happy to help. On behalf of Brian, HRQ, and Landrum HR, I am Sal Vergara. Until next time, elevate yourself and those around you.